If you're planning to retire in the next 5 to 10 years, there's a problem most people don't see coming. It's not the stock market, it's not inflation, and it's not even running out of money. It's taxes. Specifically, how quiet rule changes can dramatically reduce how much retirement income you actually get to keep. One of those changes is coming this year, 2026. And today, I want to explain what's changing, how it affects Social Security, and why tax planning may matter more than investment returns as you approach retirement. This isn't about fear, it's about preparation. For decades, retirement planning was simple. You work hard, max out your 401k, delay the gratification, and retire comfortably. That worked when pensions were common, taxes were lower, and retirement lasted 10 to 15 years. That world doesn't exist anymore. Today, retirement often lasts 25 to 30 years or more. Rules change, taxes stack, and income gets forced. And people who did everything right are often shocked by how much goes to taxes. Now, there's some rule changes for 2026, specifically to the 401k. Starting in 2026, a major change takes effect under the Secure Act 2.0. If you earn over roughly $145,000, your 401k catch-up contributions must go into a Roth account, not pre-tax. That means no tax deduction today, taxes paid now instead of later, and this applies during the years most people are earning the most money of their careers. This change doesn't affect everyone, but it affects many people right before retirement. The real issue isn't Roth versus pre-tax. Most online conversations stop here. They turn into this debate. Is Roth better? Is pre-tax better? That's the wrong question. The real question is this: how will your income be taxed when you actually need it? Because retirement income doesn't come from one place. It comes from 401ks, IRAs, Roth accounts, Social Security, interest, and dividends. Each dollar is taxed differently, and each dollar can affect the taxation of other dollars. Now, there is some difference with Social Security, the tax surprise. Most people think Social Security is either tax-free or lightly taxed. That's not how it works. Social Security uses something called the provisional income. It includes half of your Social Security benefit plus other taxable income plus tax-free interest, if we just want to make it simple. Now, as income rises, more of your Social Security becomes taxable or considered taxable income. Up to 85% of your Social Security can be counted towards your taxable income. This creates what many planners call a tax torpedo. You withdraw $1 and more than $1 becomes taxable. That surprises a lot of retirees. So how does 401k withdrawals affect Social Security? Let's connect the dots. If most of your money is in traditional 401ks and IRAs, every dollar you withdraw counts as taxable income. Required minimum distributions force withdrawals, whether you need them or not. Those withdrawals can cause more of your Social Security to be taxed. Now layer in Medicare premium surcharges, state income taxes, or survivor tax brackets. Suddenly retirement income costs more than expected. So why this makes the 2026 rule more important? Well, the 2026 rule isn't good or bad by itself. It's a signal. It shows us the government wants tax revenue sooner. It shows us rules can change quickly, and it reminds us that flexibility matters more than ever. Now, what we need to think about is tax diversification, not tax prediction. A common mistake is trying to predict future tax rates. No one knows what Congress will do. Smart planning doesn't predict, it diversifies. Tax diversification means having income that is taxable, tax deferred, and tax-free, so you can choose which bucket to pull from each year. That control is one of the most valuable assets in retirement. Now, we also have something called required minimum distributions, which can be a hidden problem. Required minimum distributions force income later in life, often after Social Security has started, other income streams are in place, and the income starts to stack. Now, taxes can rise when that happens, and retirees end up in higher tax brackets than they ever experienced while working. That's one of the biggest ironies in retirement planning. Now, Social Security timing is really a tax decision. Most people think Social Security timing is just about break-even age, but it's also a tax decision. Delaying Social Security can reduce taxable income in early retirement. It can create room for smarter planning before required minimum distributions begin. Taking it early can lock in taxable income and reduce flexibility. There's no universal answer, but there is a strategic one. Now, there is a critical planning window. There's a window many people miss. The years after work ends, but before required minimum distributions begin, often between ages 60 and 73. During this window, income may be lower. You have more control, planning options are wider, and once RMDs and Social Security are both in play, well, the flexibility shrinks. So why just the 401k is outdated? The advice to just max out the 401k came from a different era. Today, that approach can create tax concentration or forced income, reduce control. 401ks aren't bad, but they shouldn't be the entire strategy. So what does good planning actually look like? Good retirement planning focuses on income, not just account balances. It coordinates withdrawals with Social Security. It reduces forced income later. It preserves flexibility, and it adapts as rules change. It's calm, it's intentional, and forward-looking. Retirement planning doesn't have to be confusing, but it does require moving past outdated assumptions. The people who do best in retirement don't chase trends. They plan income intentionally. They respect taxes, and they build flexibility into their plans. If you're approaching retirement, now is the time to look beyond balances and ask better questions about income and taxes. Now, if this video helped, consider subscribing by clicking that button below for more clear, practical retirement guidance. Plan early, plan intentionally, and don't wait for rule changes to force your hand. I look forward to seeing you in the next video.